Hey everybody, this is Max here at WatchMadAssTrade.com, and I'm going to be coming at you with another new YouTube video today, and I'm going to be explaining a very simple concept that surprisingly a lot of people don't seem to fully understand, or maybe they just understand the definition. They don't understand how to apply it correctly in terms of day-to-day trading. So basically I'm going to be talking about the concept of risk-reward, the risk-reward ratio. So overall, I just want to make a recap on today. It was a pretty slow day today. No slam dunk trades. Ended up walking away with $553. It was pretty slow. It's hard earned $500, but glad to walk away to profit. Playing small still with the market kind of slow after the whole Ebola hype thing kind of just died out. Nothing to replace it yet. And for those of you that have been trading with me, you completely understand why I've been trading with small size and just protecting myself from any sort of over trading and unnecessarily sizing in too big. So overall, glad to be back. As you guys know, I've been out sick for the past week or so, and didn't have my voice for a huge chunk of last week. So I actually sat out pretty much Tuesday and Wednesday, stuck at the doctor's, but finally back to normal, good to go, and glad to be back. So basically, like I said, I'm going to be explaining the concept of risk reward. Very simple concept. A lot of people don't seem to get it, or a lot of you guys out there do understand the definition but don't know how to apply it. If you're already a superstar pro day trader, you can go ahead and skip this video, but I do have a lot of videos that will follow this one that require you to fully understand the concept of risk reward, the risk reward ratio. So I just want to cover this real quick. It's going to be a relatively short video. First YouTube video in a while, so I'm going to try to get back into the groove of making them. So I'm going to use NGUT as an example today. NGUT was a nice stock, made me the most money today, and gold's been in play for the past couple days. Huge gap down and trying to bounce a little bit. So gold has been in play, and pretty much every single ETF related to gold, NGUT, Dust, which is pretty much the inverse of NGUT, you got JNUG, a couple others, but pretty much good stocks to trade, although sometimes they get kind of random because gold obviously has a lot of factors affecting it, so you gotta be careful with that. You gotta have all the charts open. You got GLD, Dust, all these charts open and know, so you know what's going on. But just going to go over the risk reward concept really quick on NUG so you understand fully what I mean. So basically NUG right now, if you look at the chart, it's trading in more or less of a channel between 12 and 12.55, right? So what I mean by risk reward is pretty simple. Use your technical analysis, determine some key levels of support and resistance, right? So you see me draw the lines here, channel between 1255-ish, got a little sub channel here between about 1215 and about 1238 and what have you, and you want to play off of these levels because these levels are what you're going to use to determine how to enter and exit your trades and how you're going to calculate what your risk is when depending on where you enter the trade, and what your reward may be depending on where you exit the trade. So obviously 12 has proven to be a pretty solid support on NGUT, right? It's tested about 1, 2, 3, 4, 5 times, well, pretty much 5 times, and held it, going below it just by a couple of cents, a couple of occasions. But more or less 12 is a very key support level on NGUT, and pretty much a very key resistance is around 1250, 1255-ish. Tested it 3 times, couldn't break it, right? So more or less, if you want to calculate your risk reward for NGUT, you want to buy this stock as close to 12 as possible. So that's where your maximum, your minimal risk will be, close to this support level, and your maximum reward will also be at that support level as well, because your reward could be 1238, 1255. And what have you, right? And if you're conversely going short, you want to short as close to 1255 as much as possible, because that's where your maximum reward would be on the short side and your minimal risk as well. So if you want to buy this stock, you want to buy it as close to 12 as possible, and pretty much your stop loss will be at $12, so that's why your risk is minimized and your reward is maximized, because this thing can run back to 12.38, 12.50 and what have you, right? Pretty simple concept, right? A lot of people don't seem to get it. When it comes to entering trades, a lot of people seem to cheat themselves by buying a little bit too off support, or maybe they just chase it. And this is why I'm always a strong advocate against chasing, because when you chase this stock, you really don't have a defined risk reward setup. And, you're pretty much exposing yourself to this stock dropping to a previous level of support, and you're just exposing yourself to too much risk. And that's how I feel a lot of traders end up losing, is because they don't calculate the risk reward ratio properly. So if you're looking at a buy at 12 and you say, okay, I'm going to buy at 12 and my risk is going to be minimal, pretty much, let's just say you get in at 1203 or something, okay, because it's pretty hard to get filled at that perfect support level. You get in at 1203, let's say your risk is 3 cents to $12, and let's say you say your reward is going to be to 12.38, okay? So you're looking at pretty much a 35-cent reward for a 3-cent risk. So you want to take the risk reward ratio to that, 35 cents divided by 0.03. You're looking at almost a 12 to 1 risk reward ratio. And obviously everyone is different and their tolerance is different. They always say, rule of thumb, you want to look for ideally a 3 to 1 at least risk reward ratio before you enter a trade. But this one, in this case, if you get in as close to 12 as possible, you could say that your risk reward is to, if it's to 12.38, that's 12 to 1. If it's to 12.55, you're looking at a risk reward ratio of 17 to 1. So you got a pretty solid trade if you enter in as close to 12 as possible. And obviously trades don't always pan out, right? If it goes below 12, you stop out, you take the 3-cent loss, not a big deal. As long as you execute, you stick to your plan and you execute, you're perfectly fine. So this is really key. I mean, a lot of people aren't able to make this kind of calculation really quickly on a fast moving stock. Obviously during the day, you talk about day trading, stocks move really quick. You can't just stop there and just do some math and pull out your calculator. So you got to pretty much be able to recognize this really quickly, have your support and resistance levels already predetermined, and don't cheat yourself. Buy as close to the support as possible, short as close to the resistance as possible, and pretty much it's just minimizing your risk and maximizing your reward. It's really, really simple. And again, a lot of people surprisingly don't get that. They start chasing stocks. That's when their risk reward gets completely thrown off. Let's say you buy this stock at a random spot here, like 12.25 or something. Your risk is back to all the way down to $12, and the reward is what, to 12.38. You're looking at a 13-cent reward and a 25-cent risk, and that makes no sense, right? Your risk reward ratio in that case is not even greater than 1. So you gotta kind of reassess yourself, reassess the situation the next time you enter in a trade. And if you're losing a lot as a result of chasing and not determining your risk reward ratio based off of these support and resistance levels, you gotta kind of reassess your trading style and kind of get an understanding about why you're losing your trades. So this is a really key concept that's worked pretty well for me. It's basic, it's fundamental, it's something that I feel like you need to completely understand to go on to the more advanced stuff that I'll touch up on in future videos. So hopefully you guys got a good grasp of the risk reward ratio. Pretty simple concept. Buy as close to support, try to sell as close to resistance as possible, short as close to resistance, and cover as close to support as possible. And all it really is just minimizing your exposure to risk. That's all it really is. So you don't want to put yourself in trouble by just buying the stock at a random spot just because you think it's going to go up. You want to have a very calculated entry and a very calculated exit. And that's what trading is all about. It's very systematic, it's very mechanical, and it's about having a system and a plan that works and sticking to it. Alright guys, so like I said, it's a very short video, very easy concept. If you got any questions, feel free to email me, max@watchmanastrade.com, and we'll see you guys next time.